I'm Jesse Green, Senior Fellow at the Richmond Center. This section of the program is about the oil price crash, the outlook for prices, U.S. production, and also covering geopolitics. Let me introduce our panel today. To my left is Jason Bordoff, Professor of Professional Practice in International and Public Affairs and Founding Director of the Center on Global Energy at Columbia University School of International and Public Affairs. He is also a Senior Fellow at the Richmond Center. Among his many achievements and experiences, which you have before you, he was a Special Assistant to the President and Senior Director for Energy and Climate Change on the staff of the National Security Council and has held senior policy positions on the White House's National Economic Council and Council on Environmental Quality. To his left is Bob McNally. He is a non-resident fellow at the Center on Global Energy Policy. He is the founder and president of the Rapidan Group, a Washington, D.C. area energy market policy and geopolitical consulting firm. He has over 20 years government and market experience as an international energy market consultant, investment strategist, and White House policy official. To his left is Colin Fenton. He is also a non-resident fellow at the Center on Global Energy Policy, and from 2010 till recently, he supervised commodities research at J.P. Morgan Chase, where he was also the firm's chief commodities strategist. He has deep experience at the intersection of energy and financial markets. To get us started on this discussion today, I'm going to turn to Jason to help us begin to understand what happened to get us into the current oil price decline and current situation. Jason?
Thank you. Thanks to the Richmond Center, to David Chizer, Jesse, to you for co-organizing this with the Center on Global Energy Policy at Columbia. How long should I speak for? Are we speaking?
You can go with 8-10 minutes.
Oh, okay. I won't go that long. So, well, as everyone knows, the oil price has seen a sort of staggering drop, looking back over dramatic historic oil price collapses of the mid-'80s, late '90s, 2009. This kind of falls in with that in the significance of the oil price falling in half so quickly. In my view, and curious what Colin and Bob think, I think the primary driving factor behind this was the extraordinary renaissance in oil production here in the U.S., an increase of 4 million barrels a day in production over roughly 4 to 5 years. There were obviously lots of other contributing factors too. In the middle of last year, we saw reports of demand slowdowns, economic growth slowdowns in some key consuming parts of the world. Libyan production came back, and then went off again, but came back, which pushed prices down a bit, and then the action at the OPEC, and so prices slid from around 110 to around 80, I think, in November, and then the OPEC non-action at their meeting to maintain production level at the current levels, and then the oil price fell off a cliff after that. I think those two things were connected. I think the Renaissance and the shale boom made it much more difficult for, we can debate whether OPEC is the right term to use or Saudi Arabia, but because really it is Saudi Arabia now, made it much more difficult for the Saudis to actually cut production, and I think it reduced their options in terms of how they think about their role in the oil market, along with the fact that for a variety of reasons other OPEC and non-OPEC countries were not willing to coordinate in any sort of cut. I don't really ascribe to the sort of conspiracy theories that this was all about hurting Iran or hurting Russia. I think it was much more a pragmatic decision, learning the lessons of the 1980s, which the Saudis have been signaling for some time. In the 1980s, they cut production from around 10 to 2.2 million barrels a day. It took them decades to regain that production, and did not see as significant an impact to stabilize the market as one might have thought. And the idea that we were going to cut production, whatever would have been needed in this case, 1.5 million, 2 million barrels a day, and the U.S. would just continue growing at such a rapid rate, why would I do that? And let the U.S. kind of just offset much of that cut and take more of the market. So the idea of letting the price fall and letting markets work, this is what we have said in many countries we kind of want for decades, a freely functioning oil market where the price is set on supply and demand, not the basis of actions by a cartel in the market. But it's a historic thing, I think, for for a century or so. Someone has been in control of the global oil market, from John Rockefeller to the Texas Railroad Commission to OPEC, and basically now the price is being set for the most part, by the economics of higher cost, of low prices pushing out higher cost producers, and by the cost of the marginal barrel. This raises, I think, an important question about whether it's accurate to think about U.S. shale oil production as replacing OPEC. So the call on OPEC has become the call on shale. Is the U.S. a new sort of swing supplier? I think it's interesting to think about and has important implications. If it's true, as you heard David Schisler say earlier, shale goes offline and comes online much more quickly than conventional oil production. That means when the price falls sharply, we can see U.S. production fall sharply as well. Took about 6 months, so it's not as rapid as a Saudi production cut that happens in a matter of weeks, but still can happen relatively quickly for the oil market. And if the price were to rebound, I think U.S. shale would rebound fairly quickly as well, perhaps even more quickly, because we do have a large base now of drilled but uncompleted wells. So we're in a role now where the U.S. is not because of a central government decision, but because of 1,000 individual economic decisions, is playing a role in balancing and providing a swing capacity in the global oil market, which might mean that in the U.S. That actually may mean more volatility, not less, in the oil market, because again, U.S. shale can take 6 months or longer to respond to price changes, not a couple of weeks like a Saudi production cut can. So we're going to have to let the prices kind of go up and go down so that U.S. supply responds. And obviously, I think OPEC is still, it's far too early to claim the death of OPEC or OPEC being irrelevant, because Saudi Arabia is still the only country with any meaningful measure of spare capacity in the event that a geopolitical event were to happen and we need to balance the market. And also because when you look in the medium term to longer term, certainly we're going to need a lot of OPEC barrels to balance the global market, I think. So what does this all mean for U.S. production? I think we've seen that U.S. production will still be higher in 2015 than 2014, higher in 2016 than 2015, but we may see month-on-month declines now. We've seen the rig count collapse by half or so, and so a dramatic slowdown in U.S. drilling activity, not necessarily leading to a similar slowdown in production, because we've seen enormous improvements in productivity, concentration and focus on the most productive sweet spot areas, a host of factors that are causing we've seen the whole supply cost curve come down dramatically, so costs are coming down, so a host of factors that allow U.S. production to continue growing, if not in the 50s, then certainly in the 60s and above, I think, in my view. It's hard to predict where the oil price will be. If I was any good at that, I probably wouldn't be at Columbia. I'd be working somewhere further downtown and making more money for it. Adam Szyminski, the head of the EIA, was at Columbia yesterday and said with 95% confidence it's between 40 and 120, and that seems right to me. But I guess the way to think about it is not to predict it, but to think about the factors that could push it in either direction. And so when I look at the factors that could push it up, the market seems to have forgotten that there's geopolitical risk in the world, and I think that's important because there's a lot of reasons to be concerned about stability in the Middle East, the role of ISIS, what Saudi Arabia is doing in Yemen, in Syria, a host of other things. Libya continues to be a failed state, and I don't see that changing anytime soon. $50 crude oil is not necessarily conducive to good governance and stability, and major oil producers like Nigeria and Venezuela and Iraq and elsewhere, which I think also makes it more difficult to pull back fossil fuel subsidies that we talked about before in the major oil exporting countries, different from the oil importing countries like Indonesia or something, because they do worry about stability there. It is having an impact. Markets do balance, so it is having an impact on some of the higher cost sources of supply, like deep water and North Sea and Russia and Canada. So you're going to see those. It takes longer than U.S. shale, but you're going to see those sources of production hit, which also can cause the price to rebound. And the demand response we've seen has actually been pretty significant. So 500,000 barrels a day in the third quarter of 2014. We were seeing year-on-year growth. That's up to 1.3 million barrels per day in the first quarter of this year. We've seen U.S. product demand up around 4.5%. I want to say vehicle miles traveled up around 5%, and even bigger numbers in some other countries in India and elsewhere. So demand also is a factor. On the other side, pushing the price in the other direction is, as I said, that U.S. shale can still be resilient at low prices. Certainly the new Saudi oil policy and posture of letting markets work and not only maintaining production, but increasing production to 10.3 million barrels a day. And if they don't cut back on exports with their summer crude burn coming coming up, potentially going up to 11 million barrels a day this summer. So we're kind of in a new world. The flip side to that is, I think, looking very carefully at what, and I'd be interested to hear what Bob has to say about this, looking very carefully at what just happened with last week's change in the Saudi succession. Lots of questions about what prompted that, about the role that Mohammed bin Salman will play, who's particularly young, and exactly what sort of support there is in the regime there. So a lot of uncertainty about that, and I'm not saying we should be worried about political instability in the kingdom anytime soon, but it's just one other factor in terms of how quickly things are changing there when we think about sources of risk. Other factors that could push the price down that I'm skeptical about are, there's a lot of thought that Iranian barrels are coming back to the market, and 800,000 barrels, 1 million barrels next year with this Iran deal. I think very promising and optimistic what happened with the framework agreement, but it's going to be there's a lot of difficult things between here and there for doing all the technical pieces of that deal, and then figuring out the verification and compliance mechanism, and then figuring out the timing of the sanctions relief, and kind of only after all of that can get done might we see the sanctions start to be lifted. So I think it's still a while before Iranian barrels are rushing back. Libya could get its act together, but that seems unlikely. We could have a wave of fossil fuel subsidy reform that would affect demand, but I think actually that's probably unlikely, unfortunately, as well. And then the other factor is what happens to the U.S. shale production. And as I said, I think there we will see slower, certainly, growth in production, but I do think U.S. production will continue to grow as prices stabilize up in the 60s or maybe above because of the old drilled but uncompleted wells, the focus on the most productive areas, the productivity improvements. I mean, oil is much harder than gas, but if you look at the productivity improvements that we've seen in shale gas production, the numbers are staggering. The numbers coming out of the Marcellus are just extraordinary for what's happening in U.S. gas production, and I think that's going to remain. I think we're in a world, if not $2.50, then $3 to $4 natural gas in the U.S. for a very long time. All of that raises lots of policy issues that we can talk about here if people want to, but a lot of questions being raised about whether the U.S. oil export policy is going to change and what impact that would have on production if it did, and that's in part determined by how quickly U.S. shale continues to grow and at what point we run into even more of a bottleneck in terms of the ability of U.S. refiners to take light oil. Policy issues around the renewable fuel standard and how much the EPA is going to push up the ethanol mandate beyond the blend wall, which all indications are they rolled that back in their proposed rule, but seems to be they're going to maybe tighten it in their final rule. There's an important midterm review coming up for the fuel economy standards that we say, Obama doubled fuel economy standards by 2025, but there's a midterm review, I think, in 2018 built in. So that's going to be important to see whether those fuel economy standards stay on track or not. And then other steps being taken by the administration to address safety and environmental concerns with the shale boom here and what costs those impose on industry and what impact, if any, that has on production. Like last week, they finalized new rail safety rules to move oil by rail. I think it's an important issue. I think it's a legitimate risk that government needs to play a role in addressing, as we saw tragically in Lac Mégantic in Canada. So they put new rules in place for tank car standards, for brakes, for speed limits and some other things. And I think if you get those right, it shouldn't have a very large cost sort of on industry, but it is some cost to do it the right way, as I think we should. So there's a bunch of policy issues that sort of will play some role in sort of thinking about the outlook for U.S. production and the global market. And we can talk more about those if people want. I'll pass it on to you.
Great. Thank you very much, Jason, and thank you, Columbia and the Richmond Center for having me here. I'm delighted, and I want to congratulate the earlier panel for a wide-ranging and stimulating conversation that I actually want to pick up on. We heard oil talk through the prism of energy policy or absence thereof, environmental policy, national security, economic growth, and industry profits and stability, and so forth. Let me suggest to you, and I do want to pick up from the kind of the historical context a little bit, to suggest three things. That we've never had, never will have an energy policy, that we instead see energy through the prisms of other things, some of which I just mentioned. But the most important prism since the very beginning of the modern oil market, through which we viewed all other aspects, has been the price of oil. Second point I'd make is that the quest for price stability has bedeviled and preoccupied the industry at first and governments later on, and will for the foreseeable future. And the third is that OPEC, if not deceased, is in hospice. The chaplain has been called, and more importantly, we will miss it. Those are my three major points. First, some history. Then I'd like to walk through the TikTok and the Saudi decision and talk on some of the regime, the reshuffle issues that Jason mentioned, and maybe just a quick forward-looking comment. History. Go back to 1859. Boom busts, or really bust boom price cycles, bedeviled the industry. I mean, we had massive price instability. Then it was a niche market or illuminant replacement. We didn't have pipelines to take away the oil, and so you had price collapses. And it's Rockefeller, as Jason mentioned, comes along and sees this in the 1880s and is appalled, sees the vision of a more modern industrial fuel, but you can't have these wild boom-bust swings in prices. And so Rockefeller does a very, actually brutally effective job at bringing price stability. First by controlling the takeaway, the pipelines, the rail cars, the refineries, eventually the fields. Does a good job. We weren't allowed to have charts this presentation. But if you imagine the BP's oil price series from 1859, it looks like this until about 1880, and then it flatlines, okay? But now we come into the modern era, the 1900s, the progressive era. We can't have evil corporate tycoons bringing stability to this or any other market. And now that we've invented the internal combustion engine, we're putting oil into warships and tanks and planes and automobiles and for heating. Now it's becoming a serious fuel. Governments are getting involved. So we bust up Standard Oil in 1911, and after World War I, what did we see? Boom bust come back. We'd find a new field in Oklahoma, the prices would collapse, and industry would go running to government officials in the state and the federal government eventually. Save us, you need to control supply, you need to tell those guys to shut down, you need a tariff, etc. So you developed over the 1920s and 30s this incestuous collaboration between an industry which was terrified about what it knew would result if there was no governance in the oil market. Wild price stability that would destroy investments and prevent expansion of demand, and governments that were starting to see oil through the prism of national security, economic stability, national prestige. But the debate was being driven by oil prices. When the Seminole field was discovered in 1927 in Oklahoma, prices collapsed and industry went running to government. When prices then rose, industry said we're okay. They found the East Giant in 1931. Prices went down to a couple pennies a barrel. At this point, the FDR administration finally came in and said, we're going to assist the states in imposing real control. And so throughout history, we've had, if you want to count OPEC 1.0 as Rockefeller, really in the modern era, two other OPECs. One, as Jason mentioned, was the combination of the Texas Railroad Commission, which played the role of holding and using spare production capacity to balance the market and keep prices high and stable in the U.S. market. And then the Seven Sisters used every tool in the manipulator's toolbook to impose those high prices throughout the world. Long story, a lot of literature on it, etc. And it worked pretty well. In 56 and 67, we had large disruptions in oil supply associated with the Arab-Israeli wars. We don't really remember it, talk about it. 56 was a little bit dicey because the Texas Railroad Commission waited for a while before prices to rise, before then increasing supplies. But in both cases, the U.S. was able to balance the market. In 73, we couldn't do that. The real change, though, came a year earlier. In March of 1972, the Texas Railroad Commission, the Saudi Arabia of yesterday, met and decided to order full production. Didn't hold back a single barrel. The chairman knew at the time how momentous that was. He called it a damned historic occasion. Okay, he admitted that was the loss of U.S. control. And the Arab oil embargo a year later was actually quite small and temporary. What really sent prices high were OPEC countries just starting to post or force higher prices on us, and then misguided domestic policies that created shortages and rationing and so forth, price control. So that's what brought us the high oil prices. But the point is, at least back then, as I said earlier, we transitioned. We, the United States, handed over the keys to the car to OPEC, really Iran and Saudi Arabia, and then Iran fell apart within a few years, so it's really Saudi Arabia. I would contend that we are seeing the demise of Saudi Arabia's ability and will to control the oil market. In 2008, in the summer of 2008, oil prices peaked at $147 intraday. Saudi Arabia was basically tapped out. It had experienced what we did, we the United States, in 1972. It ran out of spare capacity in peacetime because it wasn't investing enough in its upstream to keep and maintain a sufficient spare capacity buffer. That is, to meet demand for its oil and ensure the market that it could meet a disruption or just balance a tight market, okay? Now, when prices then fell from 147 to 33 in 6 months, echo of that earlier oil price instability we all hated, the Saudis were able to put through one final, I think it's maybe the last successful OPEC action we may see, at least for a long time. Where in the Iran agreement, December 2008, they did cut. They, I mean the Saudis. They did nearly all the cutting, as Jason said. The only time we've seen meaningful cuts outside of Saudi Arabia, a little bit from UAE and Kuwait, has been in 1998, when you saw $10 a barrel oil. That will concentrate minds. Even the Venezuelans went along then, but only for about a month or two, okay? Otherwise, it's the Saudi Arabians who do the heavy lifting. So in 2008, we learned the Saudis can't impose a ceiling on price. And they've said, although they've increased since then their total production capacity to, they say, 12.5 million barrels a day, they say their policy is to maintain 1.5 million barrels a day of spare. That's not enough in a 92 and 3 and 4 and growing market, in my view, to balance the market. Rule of thumb is you need at least 5% of the market in spare. So I think if OPEC is even, Saudi Arabia is going to even pretend to reassert control of the market, we need to see a credible 4 to 5 million barrels a day of spare production capacity. Even the most optimistic numbers from the officials don't show that. What have we learned recently since 2014, transitioning to the near future? Saudi Arabia won't impose a floor. They could. They could announce tomorrow a cut in 1 million barrels a day. We would be back to $100 very, very quickly, and all would be good. And actually, that is the way I think the market expected things to work last September when oversupply developed. And they hadn't been listening to the Saudis, who had been saying for a year or so, quietly and publicly, we won't cut alone. We thought, yeah, you're just posturing. Sure, you will. You will, because you know if you don't cut alone, that oil price is going to collapse. So we know you're upset about the freeloaders and you think shale's flexible, but we know you're going to cut alone. You'll complain about it, but at the end of the day, you will do it. You did it in Iran in 2008. You did the bulk of the cuts in the late 1990s. You know, you will do it. And so I think the market was shocked. I would disagree a little bit with Jason just on emphasis. No question that the emergence of more flexible shale oil production was one factor that gave the Saudis confidence that they no longer needed to be the swing producer. I want to talk about that in a second. But I think there are two broader and bigger reasons why the Saudis decided not to cut unilaterally. One is, as Jason mentioned, an aversion to going back to the early 1980s. You got to remember, put yourself a year ago. Look at anybody's medium-term forecast, IEA, BP, EIA, and everybody. They all saw spare capacity doubling, basically. They saw non-OPEC supply growth surging, demand pretty tame at about 1 million barrels a day, the call on OPEC falling, and everyone predicted an increase from about 3 to 6 million barrels a day in spare capacity. What does that mean? Because only Iraq was expected to bring on total production, and we know they're going to produce every barrel they can. That meant that the Saudis last year were not just looking at a weakening market in 2015, they were looking at the 1980s again, where you were going to have a sustained fall in the call on OPEC, and Saudi Arabia required to cut year after year after year. And this gets to the second question, the second part of the Saudi reluctance to cut. It's not just that they saw shale come along and say, well, maybe the Americans can cut. Maybe they're like a de facto member of OPEC. They have no choice but to cut. They're more flexible. We'll see how flexible they are. And that's the experiment we're all watching right now. But the other factor, and never lose sight of this, is that Saudi Arabia was looking at losing market share to its geopolitical as well as commercial rivals. Russia selling through the ESPO pipeline into Asia, Iraq, and soon getting out of jail, Iran. Okay, and these are countries that sell the same type of oil to the Saudis, to the same growing market in Asia, and whose leaders want to slit their throats, excuse my French. So this is, I think these factors, the emergence of shale, the reluctance to repeat the early 1980s sustained period of cuts unilaterally, and the fact that the real competition were countries with which they were embroiled in intense geopolitical rivalry right up till today, explain why the Saudis simply weren't going to cut. And I think it took the market several months to realize that, and it's the shock of that that has led to this price plunge. I will say now, looking forward, I notice among oil experts and analysts often a U.S. centrism. It's understandable because the United States is not only the biggest producer and consumer, but we have the most frequent, reliable, granular, and comprehensive data. It's sort of like if you want to be, it's like the guy who lost his keys in the dark alley but is looking for them underneath the street light because that's where the light is. Okay, so where the light is, we have, in the last few years, a weakening market. Production up 4 million barrels a day is a complete shock and surprise. Lethargic demand growth, weak economic growth. You would think Brent needed to go to 70s or 80s, and many people did. But yet instead what we saw was when Brent briefly dropped into the 90s, it popped back up because outside the United States, the market was actually tight. and disrupted. And Saudi Arabia production was actually quite high. Spare capacity was quite low. Low spare production capacity, and I would argue, is the defining feature of the modern oil market and has been for about 15 years, with the brief exception of Iran from 2009. In a loose market, it's bearish. It means the Saudis are saying, go jump in a lake. We're not going to swing unilaterally. In a tight market, it's bullish. So really where you sit and stand, I think, on tight spare production capacity, and it is where you see the global oil market. And here will be my final point. I think if you look outside the United States, things are sort of reversed from 2011 to 2014. If you look at the U.S., you got to be bullish. I mean, we haven't yet had a month-to-month rollover in lower 48 production. We're getting very close, though. I think we had like 20,000 barrels a day or something in April, or in March. And some basins have declined, and so we're getting ready to see a rollover. It's taken 6 to 9 months. It's not Saudi spare capacity, which is supposed to change in 30 days. But it's going to happen. And folks are thinking, well, the U.S. is going to, the tail that's wagging the global dog, and we're going to balance the market. But I think, again, you have to look outside. And when I look outside and I look at most balances, I see massive oversupply. I see the Saudis putting pedal to the metal and keeping above 10 million barrels a day. I see Libya coming back up to 600,000 barrels a day. I see Iraq at recent high production levels. It could all go away. We could have a disruption. But I see OPEC producing closer to 31 with a call closer to 29. Well, so that oil is going to come onto the water and it'll come on shore somewhere. And when it does, I think it could produce potentially another leg down. So I think when we think about the way forward, I think no question the U.S. will swing, will adjust. We're going to learn how quickly. Now going back just on the Saudis, I realize that's one other point I wanted to make. I've been to Saudi Arabia 3 times in the last 7 or 8 months. First time was September. And in September, the view was all we have is a little end summer weakness. We're going to get the winter demand back. Everything's going to be fine. And if anyone has to do any cutting, it'll be shale at about $80. Can't imagine oil going below $80. Go there early this year, it was, wow, boy, it was, we saw $45. Clearly we misunderstood a little bit things about shale. It's proving to be a little more resilient than we thought. Remember, since October until recently, EIA has been increasing its estimates and projections of U.S. shale production in the early part of this year, decreasing them later on, but increasing them. So then it was a lot more concern and doubt and so forth, but we had the reshuffle. And then, of course, a few weeks ago, it was more determination to stick with the policy. And to Jason's point, I agree. No conspiracy theory. I am pretty sure that back in September, the Saudis weren't saying, we're about to crush the price of oil, we're going to hurt Iran, hurt Russia, hurt Iraq, and really sock it to those sale guys. That was not, because I don't think they saw the prices go as low as 40. I don't think they saw anything like that. When that happened, though, when we came into this year and we saw the prices, especially the new King Salman and his new vibrant son, now defense minister, and turns out second in line to the throne, 30-year-old gentleman, Mohammed bin Salman, who you see from Yemen and other areas. The Saudis are very bold now. Now the sense is, well, we may not have expected the prices to drop so quickly, and we may be confronting a more resilient shale production than we thought. However, we are sticking to it because we are now perceiving these geopolitical benefits. We are in it to win it. I think the Saudis are very determined to stay high and keep their production up, partly now for geopolitical reasons. So those have accreted, I think, to the oil policy, which has been doubled down upon. So last point. We were in Riyadh, some of us recently, and folks are talking through the OPEC and the IEA guys will say, well, okay, so Saudi Arabia is insisting they're not going to balance the market, so prices are going to be more stable. Can shale oil replace? Not really, as Jason said and others. It's not really fast enough. So what does that mean? I think a discussion we're going to have is use of the strategic stocks, because I think, going back to history, we will still be traumatized by oil price swings. We can't handle it economically. We can't handle it from monetary policy. We can't handle it from what to buy for defense. We will hate volatility above all. So I get in trouble, and I think I can get arrested actually in Washington for ending with this comment, that the only thing worse than OPEC controlling the oil market is OPEC not controlling the oil market. Thank you.
Thank you. Colin?
Thank you. Thank you all for coming today to listen to us. I appreciate it. And I'm going to take 5 minutes to make some comments from a financial markets perspective. And I think we all want to jump in here and ask a lot of questions, and so I do want to leave that time. I'm mindful that many of you are lawyers. And I'm speaking to an audience of lawyers, and I think I see a portrait of James Madison presiding above us over here, the father of the Constitution. So let me make 2 points to start. We heard from the first panel about renewables. So let me give you some simple facts, because you may not be aware of them. This country produces, on average, about 950,000 barrels per day of ethanol for blending into our gasoline supply. that may mean nothing to you. It's 1% of the world's supply of oil, as we analysts calculate what we call total liquids. Again, sounds totally insignificant. But let's frame the question in a different way. Our farmers plant 90 million acres with corn, and about 37% of that acreage is for the ethanol that I just described. So as a lawyer, you should be asking the question, 37, what's the acreage here? What's that in some sort of reasonable, digestible form? That acreage is larger than the entire acreage of New York State, where we are today. Now, the ethanol does not magically make itself. It does not transport itself into the Exxon station. It has to actually be harvested as corn. It has to be processed. It has to be transported. So that begs the question, what about all these tractors that move around an area that's as large or larger than New York State? Larger than 3 Switzerlands, by the way. They're powered by diesel fuel. So your next question, if you're leading the witness here, would be, well, how much diesel do I have to burn to make that ethanol? And the answer, and I just calculated this because I thought it'd be a useful point to make, is 129,000 barrels per day to make 921,000 barrels per day of ethanol last week. Well, now suddenly it's not 1% anymore. And suddenly one of the points made on the previous panel about the emissions that are part of the supply chain becomes a relevant consideration. So my first point is, as policy is set by many of you and companies that you advise, keep in mind that we already have this problem in what is supposedly part of the solution. Before we even get to Jason's point about the blend wall, and if you're not familiar with that term, it was a mandate that was impossible for companies like Valero to fulfill. And the reason why we saw some of the pyrotechnics in prices is because in order to be compliant with the law, real publicly listed companies had to basically arbitrage RIN credits, and these are a tradable security, if you will, to make 2 types of biofuel equal each other, biodiesel and ethanol. That's point 1. Point 2, and again, I appreciate many of you are probably corporate lawyers or not necessarily trying cases, but what happened yesterday in Boston, the city where I live? Johar Tsarnaev cried for the first time. Why is that interesting to me as an analyst? Because this is evidence of a very important concept that has been lost in our entire conversation today, the distinction between tribalism and the rule of law. And I don't mean that in a pejorative sense. I mean that in the sense of our ancestors for the past 2 million years have organized human civilization around a concept that your family is more important than your commitment to esoteric principles set by some authority that you've never met. And I would contend that yesterday, a person from Dagestan, one of whose family members was not allowed to attend the trial because he was a Chechen militant, demonstrated that very important principle. We, the richest society in human history, can set all sorts of principles. We can have all sorts of wonderful policies. But let's not forget that when you go through the streets of Bangkok, as many of us have done, or into Saudi Arabia or to other places around our planet, you're going to confront this challenge of enforcing even the very best principles. And we have to be pushing toward some sort of integration of the reality of what's on the ground with our best hopes. Now, a couple of quick points. Conspiracy theories. You know, I spent 20 years at J.P. Morgan, Goldman Sachs. I've personally traded Brent crude oil futures and many other commodity futures, trying to persuade folks that you can actually study these markets through an econometric lens, that they are actually fairly set in competitive markets. What's fascinating to me is everybody now wants to push aside the idea that there's a conspiracy theory, because everybody knows that's bad language. You sound like an idiot if you think there's a conspiracy theory. Let's use a different term that is more comfortable in policy circles. Power projection. I would argue that you are most definitely seeing power projection because the alternative to sending 50,000 18-year-olds to Poland or Ukraine or Estonia in using power projection is preferable to what might actually transpire. Crimea, right, is supposedly an autonomous region that had the right to secede from Ukraine and join Russia. Again, a legal principle. Does Chechnya enjoy this autonomous right? Why is that relevant? It's right next to the Caspian. It's where all the oil is in that part of the world. Could you imagine if tomorrow the United States said, instead of a third Chechen war tied to this Boston Marathon bombing, let's have an independent Chechnya. Let it join Azerbaijan or Turkey, or you go through some sort of pie-in-the-sky thesis. This is the reality that financial markets see. They see these risks. And in June of 2014, Brent crude oil had the lowest volatility in the entire history of its existence, 8% annualized. So my key point here is don't focus on the collapse in price, focus on the ascent of the risk. The risk must be managed, and it is quite sensible for the powers of the world to contain Russian aggression in Ukraine and ISIS in Iraq and elsewhere, because collectively as a species, we do not want a military outcome. I'm often asked, speculators, what's the speculator premium in price? Again, those of you who are in tax law, insurance law, a risk premium in commodity markets is not a positive number. It's not like there's a pizza pie and we slice up which slice for producers and which slice of the pie is for the consumers. It's a premium that is paid from the producer to the buyer of the risk in the form of a discount to expected price. I don't have time to go through all the math of that, but think of it as a negative number. It's a very important concept. It is not a positive integer. It is a negative number. So the price is fundamentally set, and and I'll end with this. When you ask the question, well, where are we now in terms of markets? I ran a Bloomberg screen to just give you some facts. Bloomberg tracks the economic performance and financial performance of 1,039 oil and gas producers and service companies in North America. 1,039. If you ask how many of them had negative trailing 12-month free cash flow, the answer is 555, 53% of the sample in 2014. So they enjoyed the benefit of the first half of the year. If you then say, and have cash and near cash equivalents that are less than their short-term borrowing, the answer is 214. And if you say, and all of those conditions plus a market cap greater than 1 billion, 34 companies. So here's the punch. We do not have enough investment now to sustain a 9 billion person world in 2050. We are grossly now running way too shy of whatever you think the economic mix should be for energy. So the reason why the price has to quickly skedaddle back up to where it is, and today Brent's about to get to 70, is because we must pay whoever is going to take that risk, including governments, to implement it. And if we do not, we have far greater problems from a military and social standpoint than has been discussed to point. Let me stop there.
Okay. We're going to go to the audience questions in a minute, but I have a question for the panel here. You hear discussions about oil prices on television, you read about it, and people are saying there's another leg down potentially in terms of the oil prices from here in the near term, not longer term, whole different scenario, of course. But what do you think? Is there enough inventory around that's going to come into the marketplace? Can the frackers come back into the market quickly enough that we can drive this back down again, or are we now on a slow tick up as looking forward from here?
I'll take a first whack. As I alluded to in my remarks, I'm sort of in the another leg down camp. There is a raging debate, and reasonable people can differ, but I agree with what Colin just said. We wrote a note for our clients titled, paraphrasing St. Augustine, "Lord, make me bullish, but not yet." Again, if you look at most balances, you see starting in March and April, OPEC production at about closer to 31 million barrels a day than 30 million barrels a day, and the call on OPEC at 28.5, 29 million barrels a day. Simple math would suggest that from a global perspective, the world oil market is oversupplied to the tune of 2 million barrels a day. Now, the data are not accurate, and we only see the hard data such as they are with a several-month lag, so we don't know. We're feeling our way through here. But just as, again, I think there was an overemphasis on U.S. fundamentals that were bearish from sort of 11 to 14, there may be an overemphasis on U.S. fundamentals that are bullish now, and so I would put my chips on there being another leg down before we get into the world Colin described, and I couldn't agree more strongly.
Can I just ask you, I'm curious, you said that before too, when you see oversupply outside the U.S., the time frame you are talking about, because when I look outside the U.S. at the non-OPEC, non-shale, and you see the ultra-deep water and Brazil and North Sea and Canada and Russia, those are, I think we could see production declines in a lot of these places playing out over a couple of years.
Right.
So what time frame are you talking about?
Yeah, I'm talking about the next few weeks to a quarter or two.
Got it, okay.
I guess, I come at it from a different perspective. There's nothing so sobering as having expiry approach in a futures contract. I've had the wonderful experience of working at a hedge fund for Stanley Druckenmiller, going away on my honeymoon and realizing that I was about to get walloped in one of my live positions and having to apologize to my wife, buy her a glass of wine, and trade Brent crude oil futures from the Amalfi Coast. Don't recommend it for, marital bliss. Look, the reality is oil price. That's a ridiculous thing to say. Which oil price? Brent, WCS, WTI, ESPO, Basra Light. I could go on for the next half hour. What tenor? Which futures contract? Which basis? The way that the real market works is all of these companies, all of these traders are hyper sensitive and aware of what's happening in all of these crude differentials, and it's ridiculous to suggest otherwise. So I agree with Bob that you've got to ask a question about are you talking about the next week? Are you talking about the next month? It's not like an equity where you have infinite time for the market to come around to your view of the ontological reality of the universe. You have 4 days to be right or wrong, and so that's an important point. And I would say that the volatility point, I realize it gets into like derivatives math and stochastic ideas, but it's an important one too. It is a sign of a mistake when you see people want it to be a momentum trade or it to be a new normal, because human beings love to be comfortable. So of course, after the price drops 50 or 60%, they want to say that that's my new security blanket. It's ridiculous. Ridiculous, especially because of the stationarity in the long-dated curve, which tells you that the CapEx economics are still in place. You will all have great jobs as consultants, helping these guys, do their M&A activity. And so the reality of the question is, what's the volatility? And what's guiding the volatility? The news today, you may not even be aware of this, there is a pretty meaningful probability that by Friday, the first tropical storm will appear in the Atlantic. Did you know about that? The traders do. They've already started pricing it. But you think any of them have any idea what to do with a subtropical storm that may or may not affect shipping? They have to totally guess in real time. They're not trying to predict the future. They're trying to manage the present. So if you ask me what's my own personal view, I think we have a volatility that is above normal now for the rest of this business cycle, which probably ends in 2017. We probably have that mean of 40% annualized variance around any given mean. Reasonable people can disagree on the means, and it is an extremely tough task to try to find out what that mean variance equation is. I would say that in the near term, I would not be surprised at all to see crude drop by $10 in a very short period of time, simply because we're in what's called the shoulder season, when the refineries go through their maintenance periods and crude demand eases. But I would just say that looking forward, we need to have higher prices. Would you, let me just make one other point that I think would be helpful. You heard Jason talk about crude oil exports, and I'm going to brag about him for a second. He and one of his partners wrote an excellent paper on crude oil export policy. If you haven't read it, I recommend it. As a practitioner in these markets, I would point out, though, that the United States government has already, in 2014, tweaked its crude oil export policy sufficiently that when I look at the total unprocessed liquids, last year alone, they increased by 700,000 barrels per day in the 94 million barrel per day market that Bob describes. That's a lot. The crude segment alone went from 50,000 to 500,000. You all read in the New York Times that if Saudi Arabia cut by 500,000 in November of 2014, that would somehow magically balance the market. Well, here's a number bigger than that. And it supposedly doesn't even exist. The traders know it exists. They're tracking it at Chevron and Pioneer and Enterprise. They're totally aware of it, and it is affecting those crude differentials I mentioned.
I have one more question before, and then we will go to the audience, so get your questions ready. I had an opportunity a couple years ago to go up to the oil sands in Canada. And as an engineer, I was truly impressed by the scope and scale of that operation. What impact does this have on the whole North America pricing? It's obviously expensive more expensive than, say, shale oil to produce, but how does it play into this?
I'll just give you quick facts. Whatever you feel about the oil sands, often in Manhattan called the tar sands, the oil sands represent 97% of the expected Canadian supply growth between now and 2030. So if you're a Canadian, that's a big deal. Whether it's the right decision or wrong decision, good policy, geothermal, that's debatable, but that's just the fact. Even more important, to Bob's point about global statistics, it represents 28% of expected net supply growth for our entire planet through 2030. So going back to Jeff's point on this competition between solar and gas and coal on the margin, reasonable people can have very different ideas about what the mix should be, but the scale is exactly the right point. You are talking about upwards of 3.5 million barrels per day of incremental growth in a period that sounds like a far time from now. It's 15 years from now. It's not that far away.
Okay, let's go to the audience. I see a hand back there. Let's start there, and we'll work our way down here.
Yeah, hi. Given that last comment about the tar sands, I would just like to raise the issue of the fact that I find it fascinating the disconnect between the environmental impacts that we're talking about this morning and this afternoon with the economy here, because every single thing that everybody's talking about, which is dependent on our fracking, is completely affecting climate change, and climate change is affecting all of those other factors. So you're talking about that tropical storm and that they're all predicting how that's going to impact the economies. Well, that is being exacerbated by the tar sands, for example. And that number of 97% is terrifying to me, and it should be to everybody else in this room. And the fact that we're also talking about the commodification of water when we're dealing with drilling, and that's not being included in any of these factors, and that's completely going to control how everything happens going forward. It's going to change our economy. As the climate change continues to get worse and worse, the resources that we have access to are going to decrease and decrease, and all of that is going to affect all of these economic policies. And I'm just perpetually dumbfounded by the fact that none of those conversations are happening in the same rooms. They seem to be happening all over the place. And like this morning, the environmentalists were talked about. There are no environmentalists, FYI. There's that's as non-monolithic of a group of people as you can possibly get to. And there's folks that are working with industry and outside of industry and within the government and outside of the government. And all of these factors are never included in the same piece of the puzzle. And I think that is a massive problem.
I agree with you. And look, Jason was on this panel, or is on this panel, and he was the first person who could barely contain himself to make a comparable point, right? I would direct you towards the state of Colorado. There is a company called Xcel Energy, which has, perhaps more than anybody, retired coal-fired power plants and made some of a move toward natural gas. And if you go to them and you say, well, great job, and in fact, their governor has given them a lot of credit for this, what is their number one concern right now? That nobody's going to give them credit for it. That with all of the policy on climate change that's coming to the fore this year, including Paris, that the starting point will be after all of the things they've done already. And so that they're going to actually have a much harder road to hoe, because they've already shut down their coal-fired power plants to a large degree, and they've already increased their renewables. And I think that illustrates your point, that the point I'm trying to make is the scale of the problem. If we went down to 43rd Street, we said, tell me the corn acreage for ethanol, I doubt anybody would say it's as large as New York State. But that's the real number. It's just the fact. So what do we do with that? And then think about the water, to your other point. Go to the Colorado River Basin and talk about the diversion of water to the San Joaquin Valley because of the drought that's been in the West that the press kind of discovered again this year, despite the fact it's 5 years old. Those are the facts that I think you're quite rightly touching upon, and it's frustrating because often you don't hear an integrated, holistic statement of the problem.
Next question.
Really quick, just that, methane also, sorry, I didn't say this before, but when you're talking about natural gas as being a solution, methane is anywhere from 20 to 120 times more potent of a greenhouse gas than carbon, and we never talk about that. So that needs to be part of
We
this.
talk about that all the time.
No, well, no, that's not true.
Yes, no,
I mean, the
it's getting a
government
huge
isn't.
amount of attention. EPA is putting out rules to reduce methane leakage. We're having a conversation about it with an event at the Energy Center in 2
The
weeks. There have
Clean
been all
Power-
sorts of
But the
environmentalists.
Clean Power Plan regulations are all going to push for more natural gas. Like it's getting rid of one evil and replacing it with another evil.
Well, I mean, I'll respond to that and say I think it's replacing it with natural gas, and EPA is separately taking actions to reduce methane leakage. And the question is whether there's something inherent about the nature of shale gas that results in high quantities of methane leakage, or whether it's a solvable problem. And it's a solvable problem, then we can think differently about natural gas and the role that it can play, not just in the U.S., but globally, whereas you heard me say earlier, I think we're not worried enough about where coal demand is headed and what that means for climate change, and the role that natural gas can and I think needs to play over several decades to transition us to a lower carbon economy. Because if we get rid of hydrocarbons, I mean, we just need to think about what the alternatives are to not having that gas supply available. I personally think the political economy of getting the EPA's power plant rules done and what the proposed costs would be would make that much more difficult today if natural gas was $8 or $13 the way it was 5 years ago, rather than $2.50 or $3. And the same when you look outside the U.S., and the efforts that countries are taking not just to reduce emissions, but to reduce local air pollution. So natural gas is not going to get us to where we need to be 50 years from now on climate change, but I think it has a valuable role to play, and we see all the modeling show that if you can address issues like methane leakage, we can see natural gas lower the cost of meeting our climate targets if we have the right climate policy in place. And as I said this morning, that's why we need the right climate policy in place, which we're nowhere close to having, which for those of us who care about climate change is really worrisome.
Next question, please.
Going back to
Wait for the microphone, please, just a second.
Going back to the statistic about the tar sands and 28% of the supply growth coming
Yeah.
from the tar sands.
Expected
by
supply growth, yeah.
2030. Assuming that takes into account low oil prices for a certain period of time, how does that work in that it has some of the highest break-evens, around $80 or $90 a barrel? Are these companies thinking for very long term with large capital-intensive projects?
Yeah, I mean, this is the paradox here, right? Often you hear the argument that big oil doesn't think about the future or doesn't think about all of this stuff. Let's be honest, these are geophysicists and geologists by training who are more comfortable in talking about billion-year timeframes than most of us. And when they're placed in front of a CapEx decision-making process and they have to report to a board of directors, you don't build infrastructure projects with 50-year expected lifespans and present a 6-month view. You'd be fired immediately. So again, and reasonable people cannot be enamored of the oil sands. I am totally stipulating that. But if the argument is that the second fastest growing petroleum country on the planet in 2013, Canada, basically has this resource, and that's on the table of how we're going to develop some of the energy supply to fly the airplanes, to Jeff's point. We're not using LNG to fly the airplanes. You can do all sorts of stuff with clean buses and whatever, but the airplanes are going to be facing this problem. You have to walk through then, okay, if I'm going to make this decision to go after the oil sands and scrub it and clean it and put it through all the processes that we'd all want them to have, what does that cost? And you're exactly right. It's expensive, which is part of the reason why it's being displaced by the U.S. shale production, because it's not as expensive. And by the way, it doesn't have as much sulfur and other contaminants. So, you know, as I look at the problem, I see a lot of people who did not expect a price level down to 40 now say it's impossible to get back to 90, despite the fact it's about to cross 70 probably in the next 2 days. And when you think about the shape of the forward curve, what the forward curve is telling you is the long run price probably needs to average 70 over decades to accomplish the task that Jason is talking about, that even if you are the most diehard, I must get this planet off of hydrocarbons, it is my mission in life to get us to solar and Elon's storage batteries and all the rest of it. There are 7.3 billion of us right now. There's going to be 9 billion of us in 2050. It's not a glib problem. You have to actually have a sequence of events that are financed by intermediaries. But our civilization is basically pulling away from the financing, putting it into trading houses, pretending the problem isn't there, and then expecting a contango-shaped forward curve where all of the history of these markets says that because of the hurricanes and the unexpected stochastic events, you have to have what we call a backwardated curve, where the spot price is above the deferred price to pay for instantaneous delivery. So I realize it's a little bit of jargon. I apologize for that. The point is, you're going to have a price that routinely is 90, 100, 110 again. And if you read the newspapers, it's supposedly a 0% probability, just like a below $85 price was supposedly a 0% probability. Extremely dangerous assertion to have in the market.
We go over here, question over here.
Geopolitical question. Looking at China's history, waiting 10 years to cut a deal with Russia on their terms, and similarly very favorable with Venezuela, do you have some sense that whether these talks succeed or not, that China will cut long-term deals with Saudi Arabia and Iran and Iraq at very favorable prices to the Chinese, whether anything else happens in the oil markets? And as a corollary to that, I do not know if China is a signatory to the Nuclear Proliferation Treaty, but if they are not, they have been shown willing to sell arms for oil. So we face the prospect of a nuclear arms race in the Middle East. Any thoughts about that scenario?
Some initial thoughts. I think the Chinese, as the United States, and as I think it was Churchill who said that, you know, you find oil security and energy security in diversity and diversity alone. I think China is very much going through the 12-step program that the United States went through when it, to its horror, realized its economic health and, to some degree, national security suddenly depends on the free flow of hydrocarbons from mainly the Middle East in the early 1970s. So you build strategic stocks that was discussed earlier. You implement fuel economy standards and try and cut demand and promote substitutes. But then you also go abroad and you want to develop global oil-producing companies, and you want them abroad, and you want to secure physical assets, although in a war that doesn't really help you too much if you don't control the seas, but you want to control the seas as well. And so to answer your question, I think yes, the Chinese are quite good at going to their various suppliers from Russia all the way down into the Middle East and even to the U.S., and they take some cargoes out of the Gulf and so forth, condensate and so forth. I think or rather refined products like LPG China takes from us. They will seek to diversify their source of supply. Because of the size of their market, they will be able to extract discounts and favorable terms. I think they will do that without much of an ideological bias. In my view, China's sort of looking at the Middle East and, like everyone else, seeing a region that had been sort of, the U.S. was sort of providing common goods stability there. We seem to be withdrawing. They have some chips with the Iranians, also with the Saudis. We're just there recently. I think they're cautious and waiting to see. My expectation, though, is China probably won't make a big move to go into one country or the other in an attempt to make a kind of an alliance. I think they will continue to look to diversify their supplies at a favorable cost. So.
Yeah, I mean, I agree with that. I wrote a paper last year pointing out the point that you just made about the U.S. is sitting on 700 million barrels in its strategic petroleum reserve. So the previous questioner, raises that question of, well, why don't we use the stuff we already have efficiently as opposed to going and just digging stuff out of the ground? So if you've already got it, you could sell supplies out of the U.S. SPR to the Chinese and achieve all sorts of geopolitical benefits, denying some of the important questions that you're raising and risks that you're raising, and still have all the security mandated by the treaty with the IEA. So I think you are going to see something like that begin to emerge. And that's why I say it's weird for me, having spent 20 years begging people to stop talking about OPEC and FARC rebels in Colombia and pretending like wizards behind screens create oil prices, or worse, 24-year-old hedge fund managers, who have like 5 days of experience. The reality is that geopolitics are part of our world. They always have been. And we get caught up, I think, in some of the language now. We've swung too far the other way. So why wouldn't the United States use its immense power, its moral authority, its sanctity of contracts, its rule of law, its engineers to help be a leader on climate change and the reduction of carbon and the reduction of sulfur? It'd be irresponsible not to.
Okay, next question. Let's go over here.
I'd like to just make two pessimistic comments on climate change. Echoing the lady's very important point about methane. Methane has been escaping from our natural gas production for years, if not decades. And I wish I was as optimistic as you, Jason, in terms of what we are going to see in terms of methane containment, but we remain to see it. With respect to the tar sands, there is no protector of the Canadian environment the way we have protectors of the American environment. There is no equivalent to the NRDC, and there is no body, governmental body, that tries to protect the environment the way the Americans do. The protectors of the environment in Canada are the Aboriginal people, the so-called First Nations. They tend to be the only people who have standing to slow down the development of the tar sands, because the governments, for the points that Colin mentioned, have no interest in slowing down the tar sands, both provincial and federal. And the First Nations have historically traded the environment for jobs for their people. So that situation is a complete mess.
I think everybody in the city of Vancouver would disagree with you. I mean, I think that's too strongly worded. Canada, I go there all the time. In my experience, and I travel the world all the time, tends to be one of the leading nations on our planet in terms of its attention to these issues. I take your point that maybe they could do more on government bodies, but I think that's probably a little bit too strongly worded.
I'd just like to add, I was up there, and it's a relatively small area compared to the whole northern part of Canada, that whole part of the country. It's 100 miles by 100 miles, and it's heavily concentrated. So, you know, you have to keep it in perspective overall.
I think if you look at the leakage that's now going into the Athabasca River in Canada, the kind of cancers that are being found in that region, the extent to which this water is flowing now through Alberta and into Saskatchewan, I think you would find that both of you are overly optimistic about what's going on there to protect the environment. And I would direct you to an excellent article that appeared within the past 6 months in Outside Magazine about this subject.
I did just want to say also on your natural gas point, so that my comments earlier were not misconstrued. I mean, I agree with what you said, which is if natural gas is going to play the role I described, I think it can potentially play. It only plays that role if we get it right? And that means having the right rules and regulations in place at the state level, at the federal level, not just to deal with methane leakage. There are other concerns that are, I mean, this is oil, not rail, but oil, not gas, but rail safety, about the concerns with seismic activity from the injection of wastewater. There are a host of legitimate risks and issues that need to be addressed if we're going to develop this resource, and it's important that we have the right regulations in place to do that. If we don't, it's not having the benefit that it can have. Now, you know, we also need to think about the global picture, about what I expressed earlier, which was a real concern about the pace of global coal demand growth. Part of this is about climate change. Part of it is about local pollution as well, where natural gas is many, many times better from a local pollution standpoint than coal. So there's sort of lots of environmental policy objectives that I think we're trying to achieve. But you know, it's hard. I mean, we need to make, it's easy to say, yes, we can do it as long as we get it right. It's hard to do it right because there are forces pushing back against that. It's also hard to get climate policy in place and to put a price in carbon and to do all the other things that I think are necessary to do if we're really going to solve climate change, which we are way behind the ball on, you know, doing anything close to what needs to be done about, unfortunately. So, you know, then if those other things aren't happening, part of what I ask myself is, you know, what sources of energy come into the mix if we don't have that resource, and what that means for coal demand as well as for renewables, and that's what we sort of talked about earlier, plus nuclear, which we didn't really talk about.
Yeah, and I think that gets back to the first questioner's point. I mean, we're all environmentalists, right? We're all parts of this civilization, and think about how much food each of us wastes. I'm pointing the finger at every single one of you. I bet if I go over there to that lunchroom, I'm going to find all sorts of little half-eaten bagels and stuff like that. We waste a third of our food supply in this country. I mean, you know, transport somebody from Latin America and deposit them at one of these hotels in this 3-block radius. It's grotesque. It doesn't just materialize out of thin air. It's water, it's soil, it's energy, it's money. It's money that could have been spent on something else that was more productive. So it's very important to remember that this is an integrated problem that touches all of our productive systems and all of our consumption systems. And we've got to be honest that out of the entire planet, it may be true that China as a society is pushing the envelope here on its CO2 emissions, but we are certainly have a problematic track record in terms of our waste and recycling.
Question over here?
First of all, disclaimer, I think I own an ETF which has General Motors in it, so, but I wanted to tie a comment that Jeff Heel said earlier today. The 2016 Chevy Volt has cost $33,000, or it starts at $33,000 before the tax credit. Has a 50-mile EV range. Is a plug-in hybrid electric vehicle. So you can plug it in and recharge it at night. And the gas engine gets 35 to 40 miles per gallon. Seats 5. What does that do to the price of oil? It seems to me that seems to begin to become competitive with the internal combustion engine.
Yeah, I mean, this is the scary answer. I know you don't want to hear this. What do you use to fire the electricity?
Yeah, exactly.
So you've got a problem here. I'll give you an example. So Guy Caruso and I were speaking in Boston 6 months ago. He's former head of the EIA, and a Google guy came up to us afterwards. And he was very excited about driverless vehicles and electric vehicles. And I get it. I mean, I choose to live outside of Boston for a reason. I love technology. I love that entire culture up there. But he was very unrealistic in his admiration for an electric-driven vehicle in the sense of he's not listening to Jason. How much of the mix comes from coal? You're using coal to create the electricity. That's the problem. So the technology is way out here, and the productive system is 50 to 100 years old, and it's trying to catch up. And we all want it to catch up. But Jason's demand has to be answered. When do we have a bridge to, yes, we have non-intermittent solar and wind, and we don't have to have these backup hydrocarbon supplies. And so the answer is going to be that because the Athabasca tar sands, oil sands, have such a high production cost, and because renewable depends on gas, gas depends on oil, there's some displacement effect going on in transportation, and then there's this massive free contest in power, not just in Georgetown, but in Austin, Texas, too, I will add, that it's a mess. You've got to basically have this contest play out.
In New York, I think a lot of the mix is nuclear and hydro. I think there's a lot of potential for more hydro to come down from Canada. That's the tribalism. That's exactly what I'm talking about.
But I'm not. Let's pause there. Let's pause there.
I'm asking about the price of oil. What does it do to the price of oil?
The price of oil is a global commodity. You cannot start with New York. If you want to start with New York, I will say then let's raise everything in New York, plant all the corn here, and get our 921,000. Well, we can't do that. We wouldn't have the Waldorf Astoria anymore, and we'd hear all the provincial tribalism aspects here. We all do it, and we're supposedly some of the most educated people on the planet who don't do this stuff. The problem is it's integrated. Oil prices are going to go up, and they're going to go up because we flagrantly use more supply than we need. Do we need to have all these lights on right now? Are the lights in the hallway necessary? Do we have compact fluorescent? We haven't done half the stuff that needs to be done. And when we get there, then we'll have the right to say, well, I really don't want to have the $90 become 40, become 60. But the challenge is that Silicon Valley is on the game. They are creating the storage technologies. They are creating the driverless vehicles. The technology sees a vision. And by the way, if they succeed, they'll obliterate all of this CapEx that has happened in places like the oil sands. So there'll be hundreds of billions of dollars that just go up in smoke and jobs go away. So the policy that I think we're trying to get at is there a way that we can acknowledge all of these are true vectors in the problem, and we diminish some of the, the worst scenarios for the economy, for individual people, and and so on. But I agree with you. A 5-person vehicle that's electric and is tooling around New York State, that's great. But a 50-mile radius in Colorado means something quite different than it does in Manhattan. It just does.
Let me take a stab, too, and build on that. And just to answer, I think the answer to your question, what will that car do to oil prices and demand, is nothing. Okay, let me read. May 5th, General Motors and Ford both reported stronger than expected April U.S. auto sales as strong bus demand for trucks, crossovers, and SUVs kept the industry on track to see its best year in almost a decade. So I think to believe that electric vehicles would have a meaningful impact on oil demand and thereby price, notwithstanding the rebound effect and so forth, I think we're talking decades of sustained massive penetration from a very low base. And that would have to be driven by two things, policy or price. I think the history of our country's fuel economy programs, the CAFE program, shows there is very little political will to impose on consumers and motorists fuel-efficient vehicles they don't want to buy. We have raised fuel economy standards only when gasoline prices were rising at the same time, so consumers were wanting to get into slighter and smaller cars. But then what we saw in the late 1980s, when the price of gasoline went down but the standards were put in place, what happened? There was a bite there. Suddenly the policy conflicted with what the consumer wanted to do, which is to drive heavy cars like I just described. What happened? There was pressure in Congress, and the Transportation Secretary lowered the standard. Then we got into the 1990s. What did we do then? We found a loophole in the fuel economy standards. Americans are extremely ingenious, and we discovered a loophole that allowed consumers to buy and oil companies to make safari vehicles and call them light trucks. And Congress, under President Bill Clinton, passed a law saying to the Department of Transportation, thou shalt not even think of revising the fuel economy standards to prevent the consumer from getting into these SUVs. My point is just that there's very little, if forced to choose between a low price of a consumer that wants to buy a heavy, powerful car and a policy objective that says we need to conserve and use less, elected officials will opt, I believe, for the former. So if we're going to get into see electric cars to penetrate the market in a way that will hit the oil demand, notwithstanding the fact it's a global market and so forth, I think we need to see $6 gasoline for 20 years, and policymakers, change their view on that.
Can I give an anecdote on that, Jason and Jesse? In 05, I was at a hedge fund, and that was 10 years ago, when Katrina and Rita barreled through the Gulf. Remember that? And a very important thing happened that I, as an economist, did not expect. We actually saw the entire system drain of supply. And what that enabled us to do was to see what the true marginal demand was, at what price, for a barrel off of the Colonial Pipeline. And it turned out the one little area that popped up out of this exercise was Atlanta, Georgia, Buckhead in particular. And in Buckhead, one of the wealthiest enclaves of the United States, as there was no supply, CNN drove to a gas station, and I couldn't even believe this was happening in front of me on TV. They find a fellow in front of a massive SUV smoking a cigarette at a gas station, sunglasses on his head, and they say, well, what do you think about these $5 gasoline prices? As he's already filling it up, he's already paying this price. And he says, it's ridiculous. It sure makes it hard to go out and get my cigarettes. And I thought, we found him. We found the true marginal guy. Now, I suspect if I went to a single mom in San Diego, she would have a different perspective. And yet, in a society of 319 million people, the truth is that there is a hockey stick shape to this curve, and we probably have vast swaths of the society that will pay, in Connecticut in particular, $5 to $8 without even thinking about it. And that's the problem, that we're nowhere near the costs. You do have to tax the gasoline. You do have to do something that makes people wake up and say, wait a minute, this maybe isn't what I should be doing. But until you get to that point in time, whether the market does it or policy does it, at $2.50, you're nowhere close.
Let me just quickly say, because I know we have to wrap up, that I both agree and disagree. I think advances like the one you're talking about, I think, are really exciting. We have the potential through hybridization to significantly increase the fuel economy of the fleet. It's the fact that when you think about oil demand, what matters is actually not miles per gallon, but gallons per mile, and you get diminishing returns from continuing to raise fuel economy. It means you can actually get a lot of benefit from just increasing it from 10, 20, 30, 40. You don't have to get to, fully electric even. The problem from a climate pollution security standpoint is that oil's really good at what it does. And it's hard to find things that do the job of oil as well as oil does it in terms of how relatively inexpensive it is, easy to transport, very energy dense, which is the challenge we have with storage. But over time, that can change, but I think the question you heard me ask this morning about the difference I heard between Michael Gratz and Jeff Heel was, my view with this doesn't happen because some new technology comes along that consumers decide is better than oil. It's going to be driven by policy. It's the role of government is to internalize social costs and address the problems that we're trying to, why are we trying to reduce oil consumption? What's motivating that? What are the externalities we're talking about? I think you have to have that policy. I do think when you look further out and think about technological tipping points and the kind of step change that might in the future, you start to see if we see car sharing with less ownership of vehicles, and then you think, well, at some point, autonomous vehicles where actually the car's coming to you by itself. And right now, we all have these cars, not in New York as much, but most people, that we use like 5% of the time. They take up a lot of space. They're expensive to manufacture. They're energy intensive. And we don't use them very much, but if you had car sharing, we're using a car 30 or 40% or 50% of the time instead of just a couple of percent of the time. And then that actually changes the way you think about the economics of something like electric vehicles, which is a larger upfront capital cost but a lower operating cost. Well, if that car is operating 40 or 50% of the time instead of 5% of the time, maybe it makes more economic sense now. So you can envision how kind of urban areas can develop, not over the next couple of years, but next couple of decades in pretty exciting ways that could really lead to those tipping points where we see global oil demand actually start to decline. But I still am of the view that that doesn't happen without policy driving it, not just innovation in the marketplace alone, that you need both.
All right. We probably should be wrapping up at this point. I want to thank all of you for being here. I especially want to thank Camille and Kathleen from the Richmond Center who've helped put this together. Thank you very much for your efforts. I'd like to especially thank my panel. This has been an excellent discussion. I hope all of you have picked up some points on this, and thank you for coming today.